Warren Buffett, the Oracle of Omaha, needs no introduction. Known for his incredible investment prowess and his down-to-earth personality, Buffett has become a household name. His journey from a young boy with a paper route to one of the richest men in the world is nothing short of legendary. Over the decades, he has built an empire that stands as a testament to his financial genius and unwavering principles. His company, Berkshire Hathaway, is a behemoth in the financial world. Originally a struggling textile company, Buffett transformed it into a diversified conglomerate with holdings in various industries, from insurance and utilities to railroads and consumer goods. The headquarters in Omaha, Nebraska may seem unassuming, but it is the nerve center of a global financial powerhouse. Buffett is known for his investing acumen. His ability to analyze financial documents and identify undervalued companies has earned him a reputation as one of the greatest investors of all time. His investment philosophy, which emphasizes value investing and long-term growth, has been studied and emulated by countless investors around the world. He's also known for his folksy wisdom. Buffett's annual letters to shareholders are filled with insights and advice, often delivered with a touch of humor and humility. His ability to communicate complex financial concepts in simple, relatable terms has endeared him to both seasoned investors and novices alike. When Buffett speaks, Wall Street listens. His opinions on the market, the economy, and individual stocks can move markets and influence investment strategies. His words carry weight, not just because of his success, but because of the trust and respect he has earned over the years. And right now, his actions are speaking volumes. In recent times, Buffett has been more cautious, holding on to a significant amount of cash. This has led to speculation about his next big move and what it might mean for the market. Investors are watching closely, eager to see where the Oracle of Omaha will place his bets next. Berkshire Hathaway has always been a beacon of stability. Through market booms and busts, the company has maintained a steady course, guided by Buffett's disciplined approach to investing. This stability has made it a favorite among long-term investors looking for reliable returns. They're known for their long-term investment strategy. Buffett's philosophy of buying and holding quality companies for the long haul has proven to be incredibly successful. This approach has allowed Berkshire Hathaway to weather economic storms and come out stronger on the other side. Historically, they've been a net buyer of stocks. This means they typically buy more stocks than they sell, taking advantage of market opportunities to acquire valuable assets at attractive prices. This strategy has contributed to the company's impressive growth over the years, but something has changed. Recently, Buffett has been more conservative, opting to hold on to cash rather than making large investments. This shift has raised questions about his outlook on the market and the economy. Is he anticipating a downturn? Or is he waiting for the perfect opportunity to strike? Only time will tell, but one thing is certain. When Warren Buffett makes a move, the world pays attention. Berkshire Hathaway has shifted course. For decades, the company, under the leadership of Warren Buffett, has been known for its strategic acquisitions and long-term investments. However, recent actions indicate a significant change in their approach. For 9 consecutive quarters, they've been a net seller of stocks. This means that instead of buying more shares, they have been offloading their existing holdings. This is quite unusual for a company that has historically been a net buyer, always on the lookout for undervalued opportunities. This is a significant departure from their usual behavior. Typically, Berkshire Hathaway is known for its patience and its ability to weather market fluctuations without making hasty decisions. The fact that they are now selling more than they are buying is a clear signal that something has changed. It's a sign that even the Oracle of Omaha is wary of the current market conditions. Warren Buffett, renowned for his optimistic outlook and confidence in the American economy, seems to be taking a more cautious stance. But that's not all. There are other indicators that suggest a broader strategy at play. Berkshire Hathaway has also been amassing a mountain of cash. This isn't just a small increase. Their cash reserves have grown to unprecedented levels. This accumulation of cash is not a common practice for a company that usually prefers to invest its capital. Their cash reserves have been steadily increasing. This growing pile of cash suggests that the company is preparing for something significant. It could be a defensive move, a way to safeguard against potential market downturns, or it could be a strategic reserve for future opportunities. This suggests that Buffett is preparing for something. The meticulous planning and strategic foresight that Buffett is known for are likely at play here. He might be waiting for the right moment to make a big move, one that could redefine the market landscape. He's waiting for the right opportunity to deploy that cash. Whether it's a major acquisition, a significant investment in a new sector, or a strategic move to capitalize on market conditions, one thing is clear. Warren Buffett and Berkshire Hathaway are poised for action. The financial world is watching closely, waiting to see what the next chapter will bring. Warren Buffett is known for his candid assessments of the market, but lately he's been uncharacteristically quiet. In recent interviews, he's avoided giving direct answers about the economy. When asked about the potential for a market crash, he's dodged the question. This silence speaks volumes. Buffett's evasiveness is a red flag. It suggests that he sees trouble on the horizon. He's not ready to make any bold predictions, but he's clearly concerned. If we look back at history, we can see a pattern emerging. Berkshire Hathaway's current behavior mirrors their actions before previous market crashes. Prior to the dot-com bubble burst and the 2008 housing market crash, Berkshire Hathaway accumulated massive cash reserves. They then used that cash to buy up undervalued assets during the downturn. This strategy has served them well in the past. Could history be repeating itself? Section 5. The housing market déjà vu, similarities to 2006. There are some eerie similarities between the current market and the pre-2007 housing market. Back then, the housing market was booming, with home prices skyrocketing and buyers eager to get in on the action. It seemed like everyone was investing in real estate, convinced that prices would only go up. In 2006, Warren Buffett warned about a housing bubble. He was one of the few voices of caution amidst the frenzy. Buffett, known for his investment wisdom, saw the unsustainable growth and the risky lending practices that were fueling the market. He saw the signs of excess and speculation. Real estate agents were showing homes to buyers who were often unqualified, and bidding wars were driving prices to unprecedented levels. Open houses were crowded and the fear of missing out was palpable. He predicted a market correction. Buffett's warnings were based on solid analysis, and he knew that the market couldn't sustain such rapid growth indefinitely. He foresaw that a correction was inevitable and that it would have significant repercussions. His predictions proved to be accurate. When the market finally corrected, it wasn't just a minor adjustment, it was a full-blown crash that led to widespread financial turmoil. Real estate offices closed, construction projects were abandoned, and the ripple effects were felt across the global economy. The housing market crashed, triggering a global financial crisis. The impact was devastating, with millions of people losing their homes to foreclosure and financial institutions collapsing under the weight of bad loans. The crisis led to a severe recession that took years to recover from. Fast forward to today, and we're seeing some of the same warning signs. Home prices are once again reaching record highs, and there's a sense of déjà vu in the air. Economists and financial analysts are starting to raise red flags, warning that we could be heading towards another bubble. The question now is whether we've learned from the past or if history is about to repeat itself. Section 6. On the ground, Miami and Phoenix raise eyebrows. Certain sectors of the market are showing signs of overheating. Cities like Miami and Phoenix have experienced significant price increases in recent years. This rapid appreciation raises concerns about a potential bubble. While rising prices can be a sign of a healthy market, excessive speculation can lead to unsustainable growth. The key question is whether these price increases are driven by fundamentals or speculative fervor. Section 7. Is another 2008 on the horizon? So is another market crash inevitable? It's impossible to say for sure, however the warning signs are there. Berkshire Hathaway's actions, Buffett's evasiveness, and the echoes of past market crashes should give us pause. The market is cyclical. What goes up must eventually come down. The question is not if, but when the next correction will occur. Section 8, a word of caution, speculation versus certainty. It's important to note that these are just observations and interpretations. We can't predict the future with certainty. While the historical parallels are concerning, they don't guarantee another market crash. The market is a complex beast influenced by countless factors. It's essential to approach these discussions with a healthy dose of skepticism. Section 9, the bottom line. Proceed with prudence. While we shouldn't panic, we should proceed with caution. The market is showing signs of vulnerability. It's a good time to review your portfolio and make sure you're not taking on more risk than you're comfortable with. Remember, investing is a marathon, not a sprint. A long-term perspective and a disciplined approach are crucial for weathering market storms.